When an ATO audit ends with extra tax to pay, the tax itself is often the smallest part of the bill. On top come administrative penalties and the general interest charge, and in serious cases, they can double or even triple the total amount payable. I am Tin Lock Shea, tax lawyer at Australian Tax Experts. The good news is that these amounts are not fixed in stone. In the next few minutes, we will look at how penalties are calculated, how interest quietly compounds in the background, and, most importantly, how both can be reduced, sometimes all the way to nil through a well-made remission application. 4 numbers set the scene. 75%, the top base penalty applied to the tax shortfall where there's been intentional disregard of the law. Around 11%, the annual rate of the general interest charge, compounding daily, and no longer tax deductible since the 1st of July 2025. 200%, how high Part 7 penalties on unpaid superannuation guarantee can go. We had those remitted to nil in one case, and we will come back to that story. And 80%, the automatic penalty reduction for a voluntary disclosure made before the ATO notifies you of an audit. Notice the pattern. The numbers punish silence, and they reward coming forward. First, get the anatomy right, because 2 very different charges sit on top of the tax. Administrative penalties are imposed for conduct, a false or misleading statement, a failure to lodge, or entering into a tax scheme. They are calculated as a percentage of the shortfall, the difference between what you paid and what the ATO says you should have paid. The general interest charge is different. It is not a punishment, and no one decides to impose it. It simply runs, automatically, from the day the tax was due until the day it is paid, compounding daily. Both can be reduced, but they are remitted under different tests, through different arguments, and only if you actually ask. Confusing the two is one of the most common mistakes taxpayers make. So how big is the penalty? It starts with a ladder, and your conduct decides the rung. 25% of the shortfall, where the ATO considers you failed to take reasonable care. The honest but careless taxpayer. 50%, where you were reckless, where you saw the risk, or should have, and pressed on anyway. And 75% for intentional disregard, where the law was known and ignored. Remember what the percentage applies to, the shortfall itself. On a $200,000 adjustment, the difference between reasonable care and recklessness is $50,000. That is why the characterization of your conduct is worth fighting over. It is often the single biggest number in dispute. The base rate is only the starting point. It moves in both directions. It moves up by 20% if you have a history of penalties, or if you obstruct the ATO during the audit. It moves down dramatically for a voluntary disclosure. Disclose before the ATO notifies you of an audit, and the base penalty drops by 80%. Even disclosing after notification still earns a 20% reduction. And on top of these statutory adjustments sits the ATO's broad discretion to remit, to reduce or eliminate whatever penalty remains, which means the final number is shaped as much by how you respond to the problem as by the problem itself. Timing, candor, and cooperation are worth real money. While the penalty argument plays out, the general interest charge keeps running in the background, and on older debts, it often ends up bigger than the penalty. 3 things to understand. It runs automatically, from the day the tax was due until the day it is paid. No ATO officer decides to impose it. It compounds daily at around 11% a year, a rate reset quarterly, and well above commercial lending rates. And since the 1st of July 2025, GIC is no longer tax deductible. That last change matters more than it sounds. The interest used to be softened by a deduction, and now it is not. Every day a disputed debt sits unresolved, the after-tax cost is growing faster than it ever has. Now to the part that saves money, remission. The ATO has a genuinely broad discretion to reduce penalties, even to eliminate them entirely. Its published guidance points to the factors that matter. A prior history of good compliance, years of lodging and paying on time count strongly in your favor. Cooperation, full and frank engagement with the audit, rather than obstruction or delay. And mitigating circumstances, serious illness, financial hardship, natural disaster, events that explain how the shortfall happened. But here is the critical point. Remission is never automatic. It must be requested, the grounds must be argued clearly, and every claim must be supported by evidence. A bare, "Please reduce my penalty," almost never succeeds. Let me show you what a strong remission case can do. A well-known Sydney franchise business came to us facing Part 7 penalties of 200% of its unpaid superannuation guarantee charge, an enormous additional liability sitting on top of the SGC debt itself. We built the remission submission around 3 pillars. The employer had cooperated fully with the ATO at every step. It had come forward with a voluntary disclosure, and it had no prior history of non-compliance. The ATO accepted the submission and remitted the penalties in full, from 200% to nil. Same facts, same taxpayer, same law. The difference between the opening position and the final outcome was the quality of the case that was put. Interest can be remitted too, though the bar sits higher than for penalties. The ATO will generally consider GIC remission where the delay was caused by its own actions, where the taxpayer has been seriously ill, or where exceptional circumstances make the full charge unjust. Be realistic, partial remission is far more common than full remission. But on a large debt that has been outstanding for years, even a partial remission is a very significant saving. And remission is now worth more than it has ever been. Because GIC incurred from the 1st of July 2025 is not deductible, every dollar remitted is a full dollar back in your pocket. And remitted GIC does not come back in as assessable income. The arithmetic has never favored a well-made application more. So what separates the applications that succeed from the ones that fail? 4 disciplines. First, engage the ATO's own guidelines. Frame your application around the factors its published guidance says matter, because that is the checklist the officer is working through. Second, evidence everything. Medical records, financial statements, correspondence. Assertions without proof rarely move a decision-maker. Third, tell the story clearly. Identify the mitigating factors and connect them directly to the shortfall or the delay, so the officer does not have to join the dots themselves. And fourth, get the timing right. Disclose early, apply promptly, and keep cooperating throughout. Remission decisions involve genuine discretion, and discretion responds to presentation. A well-prepared submission consistently outperforms an unstructured request. This is daily work for us at Australian Tax Experts, where tax lawyers and accountants work as one team. We review penalties and interest, testing how the numbers were calculated and assessing your realistic prospects of remission before you spend a cent chasing it. We prepare remission applications that are thorough, evidence-based, and strategically framed, built on experience across hundreds of ATO matters, including that 200% penalty remitted to nil. And where remission alone is not enough, we handle the wider dispute, objections, payment plans, and negotiated settlements. If there is a penalty on your assessment, the worst thing you can do is simply pay it without asking whether it should be there. If you are facing ATO penalties or general interest charges, talk to us before you pay. We can assess your prospects for remission and manage the application on your behalf. Visit australiantaxexperts.com.au/contact for a confidential assessment. Thanks for watching, and remember, this presentation is general information only, not personal tax or legal advice.